Good morning, everyone. This is Corey Hinkle here with your Ankerstar Wealth Daily Update. We've got a very interesting show, kind of a lot going on out in the markets today, but we'll do a quick market update. We're going to take a look back at this recent correction from where we bottomed in early April, and we're going to look at that correction from another angle, and we're going to ask ourselves, what did we really correct internally in the market during that correction? We're going to look at inflation numbers that came out today and some implications around that. We got some positive news on China-U.S. trade deal. And then we are going to also look at what happens when an unstoppable force meets an immovable object. So a lot to get to. Remember, this is a financial education presentation. You must do your own due diligence before acting on anything you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and mine alone. All right, first and foremost, a market update. So we're looking here at the S&P 500. The S&P 500 is a mere 1.3% away from all-time highs right now, and the expectation is, as mentioned yesterday, that we're going to take those highs out here soon. So that's the expectation. And then, of course, what comes after that, we'll have to see what the market has for us there. But the energy expended to get back to this point is probably going to be a reason for at least some level of pause at some point. Possibly get a little overshoot to the upside and then some level of pause there. But that's the baseline expectation. Now, I do want to look at, okay, during market corrections, that word correction is important. It should represent that something was reset. There was some reset underneath the market, and maybe that be in earnings, maybe that be in valuations, maybe that be in inflation. It could be any number of things, but it should be some reset that brings the market back to a healthier place moving forward where things can go higher. What you're looking at here on this chart, these are S&P 500 forward price to earnings ratios. So these are valuation metrics. These are index wide. So, based on the whole index. This is, of course, a relatively simple metric in itself. One of the first ones that people tend to look at when valuing companies or markets in general. But it's not so much the metric that's important here. It's where were we before the dip and where are we now? So if you go take a look there, you can see before the dip, we had valuations that were elevated. We'll be nice. We'll say elevated there. Now, let's also remember, these valuations are elevated for a very, very good reason in the market today. And that reason is we're likely investing through a generational opportunity in technological advancement, which is what we commonly call artificial intelligence or AI. This is a scary time to not be invested. And I feel for people who are not close to fully invested in equities, because this is not something you want to miss. This is maybe even something you can't afford to miss. So valuations are high. Valuations are high for a reason. But where were we and where are we now? We were pricing earnings, pricing companies and indices around 22 times earnings prior to the dip. We got down below 20 for a couple of weeks, maybe 7 days, and we're right back pulling up close to 22. So we had all that pain, and it was painful, but we really, now that we're back to 1.3% away from all-time highs, we really haven't corrected high valuations. Now let's contrast that scenario back to the great financial crisis. Of course, much longer, much more painful. But we're going to contrast what was actually corrected then versus in this case, we see that nothing was really corrected. Okay, let's go back there. So the market actually put in a massive top in the year 2000, and the market didn't hit new all-time highs again on a price basis until 2013. So let's go and look. By the time the market got back to all-time highs, valuations were essentially cut in half at that point. So the price of the index was back to all-time highs, but the valuations were deeply depressed here in 2013. So what does that mean? Once you got back to all-time highs in 2013, you had plenty of room to run much higher because valuations were still depressed, even though index price was back to all-time highs. It gave you a runway to go much, much higher. What runway do we have today once we get back to all-time highs? Again, we do have that generational technological advancement that is justifying high valuations. But of course, there are upward bounds there. You know, we aren't totally unlimited to the upside on a valuation basis. So that's going to be a headwind. Whereas in 2013, when you got back to all-time highs, valuations were still a tailwind, pushing you faster than you otherwise might have gone, pushing you higher faster. So I wanted to mention that. Markets are moving a bit higher today, though, and we mentioned we're about 1.3% away. Part of that is because U.S. inflation is dead. It's dead. It rose 0.1% in May from the prior month, which was less than expected. You can see this on a chart over here on the right. You know, we had that big surge of inflation where month over month we were getting a pretty large pops, and that's come all the way back down to, we'll call it a normal range or a healthy range. But really, you know, it just means inflation at this point is dead. So Warren Pies points out from 314 Research, he points out that super core inflation, back out a few things like housing and energy, it was over here, a lot of numbers here, but it was right down here. It was 0.06 of 1%. You know, again, inflation in the United States is dead. The Federal Reserve should probably be lowering rates because of this, right? Well, they aren't. So J.D. Vance came out today bashing Chair Powell, the Federal Reserve. They should be, you know, they're committing monetary malpractice by not lowering rates at this point. There's one reason why the Federal Reserve is not lowering rates at this point, and that is they are anticipating a tariff impact to consumer prices. They're anticipating tariff-related inflation. Of course, the Federal Reserve typically claims that they are data dependent and they only use data to make their decisions. But it does appear that they are doing some forecasting related to tariffs, and they're doing some anticipation, and they just can't lower rates yet with that uncertainty overhead. And there are still some tariffs in effect that will remain in effect. At least that's the expectation. There's one other thing, though, that the Federal Reserve is looking at that is different from past rate cutting cycles. Rate cutting cycles, we're seeing rates fall across the entire yield curve. So all of these other lines, kind of the faded looking lines, represent other rate cutting cycles that have taken place. In those rate cutting cycles, when the Federal Reserve began lowering rates, those rates remained flat or tended to trend down. In this case, the exact opposite thing has taken place. When the Federal Reserve started lowering rates last year, we immediately, and it actually kind of front ran the Fed a little bit, but immediately we started to observe rates moving higher. the 10-year, the 20-year, the 30-year, all moving higher. Now, what we have now is a kind of a normal yield curve. We've got short-term rates in the low 4s, longer-term rates up at about 5. But this shows you that red line, it shows you that these longer-term, the 10-year has moved up 100 basis points. That's a full percent since the Federal Reserve started cutting. The people wonder, is the bond market telling a different story? Is the bond market signaling that inflation is kind of an inevitable here and that the Federal Reserve cannot afford to lower rates? So any further lowering of rates, which would, in theory, kind of juice the economy a bit, is going to overheat the economy again, and from there create inflation problems again, meaning that you might lower rates temporarily, but the bond market could be signaling it's not a sustainable thing. Of course, there's a lot of complexities here. We don't know exactly how any of those situations would play out until they happen, in real life. But this is one of the things that the Federal Reserve is monitoring, and one of the things that they have to be mindful of as they make this decision. My perspective is, if you look at this commodity cycle that we're in, we talked about it yesterday. You look at high valuations across real estate. You look at all the money printing that the Federal Reserve has done in the past 5 years. I'm not sure that lower rates would have the effect that the administration would like for them to have. Of course, it would lower interest payments to an extent, but I tend to think that we're even though inflation is dead, we're a little bit closer to inflation than the Federal Reserve wants us to be. Kind of, if you look at the ingredients that create inflation. So I tend to believe that rates aren't going to go much lower from here, but we'll see. Okay. One other positive piece of news that came out today: China and U.S. officials reach agreement for allowing rare earth tech trade. Now it's up to Trump and Xi. So my understanding of this is the officials met in London. They did come to an agreement. It's kind of one of those things where, you're at your friend's house and you're like, oh, we should have a sleepover tonight. I want to stay at your house tonight. And you're both like, oh, yeah, that's a great idea. Okay, now we need to go back and talk to our parents about it. So Trump, of course, he did send some messages out from his social media platform, Truth Social, mentioning that these are exciting developments and this is good, but we don't have an official signed agreement yet. And then Trump and Xi haven't officially agreed to some parts of this yet. So we're still waiting on that. But as I mentioned earlier this week, we're seeing a positive trend in these talks, and that's about all that we could hope for. And frankly, having started the talks on Monday, to have Truth Social posts going out about the excitement and progress on Wednesday is a pretty quick turnaround. So all good there. And one of the reasons likely that the market is moving a bit higher today. Okay, I did want to hit on this right at the end. Last week we did see what happens when an unstoppable force meets an immovable object. And in this case, we had Trump versus Elon Musk. Well, who blinked first, or which one lost? Was it the unstoppable force, or was it the immovable object? And in this case, we had that there was the richest man in the world versus the most powerful man in the world. Well, it turns out that the most powerful man in the world won this round. So Elon Musk says he regrets some social media posts he made about Trump. There you have it. The richest man in the world did not beat the most powerful man in the world. So Elon Musk is backing off some of this. Tesla stock has rebounded nicely. Tesla did have, I think, 2 robo-taxis driving in Austin yesterday, and we'll see what happens with that. I think they might go live with rides for, just a few select vehicles on June 22nd. So, hey, we'll see. Waymo certainly got a lot of publicity this past weekend for being accidentally associated with some riot activity in Los Angeles. But, now Elon Musk's Tesla is joining the party on the autonomous vehicle ride business. So that's all I have for you today. I hope you enjoyed our show, and we will be back tomorrow.